Well, shares in Australia's biggest oil refiner, Caltex, plunged today after the company announced first-half profit could slide by as much as 39%. And Caltex has warned the outlook for the second half of the year is uncertain due to the impact of the high Australian dollar. Andrew Robertson reports.
Just 4 short months ago, Caltex unveiled a 49% increase in full-year profit. As recently as April at its annual general meeting, the company was still bullish about the outlook for this year.
In refining, the medium to long-term outlook for supply and demand fundamentals are expected to improve, as we have previously outlined. However, we expect to experience short-term volatility due to the events in Libya and Japan.
But now Caltex sees a different situation. In a statement to the stock market, Caltex said it's expecting its first half profit to be a maximum of $115 million. Last year's first half was $163 million. For resources analyst Gavin Wendt, the announcement is no surprise.
Caltex is being hit by rising currency. And also on the cost side, it's having to import crude oil at much higher prices. So as a result of all that, its margins are declining.
Long-time oil industry watcher Kevin Hughes believes Caltex is suffering from not having its own oil wells in a volatile oil market.
If you haven't got your own crude oil, what it means is you can't share in the world profit margins for selling of crude. In other words, they have to buy their crude on the open market, the same as anyone else.
Adding to Caltex's problems, it's been confronted with longer than expected interruptions to production at its Sydney and Brisbane refineries while major maintenance work was carried out.
Refineries are always very costly to maintain, particularly if they are older refineries, and all of that helps to delay production and, of course, reduces their refiner margin.
Then there's the Australian dollar, which Caltex says this year is an average 17% higher than 2010, wiping $35 million off pre-tax profits. That was only partially offset by foreign exchange gains on crude and other products bought overseas.
We talk about miners and that sort of thing hurting, but the refining business, which is already under pressure, this could be the last, the final nail in the coffin of the refining industry.
On that point, Gavin Wendt believes within the next 10 to 15 years, Australia will be importing all its fuel needs.